Welcome to this farmdoc webinar presentation. This is Scott Irwin along with Darrel Good. We are both of the Department of Agricultural and Consumer Economics here at the University of Illinois. And this is a farmdoc webinar that is entitled today, Outlook for Corn and Soybean Prices, following the USDA's estimate of June 1 stocks and planted acreage. We will begin this morning with a 30-minute presentation. I'll do the first part. Darrel will be doing the second part. And then we'll continue with about a 30-minute Q&A session. Please know that you can submit questions at any time during our presentation or the Q&A period. We also note that if you have any audio problems on your end, that you can consult the email for directions about calling in with the telephone number to listen. So, also some more information about how you can get follow-up materials for this webinar. The PDF of the slides that we're presenting this morning are available at the web address that you see on the screen, farmdoc.illinois.edu/webinars, and a complete video of the presentation and our discussion of the questions that are submitted will be available tomorrow. And again, please be thinking about any questions you want to submit and start putting those in at any point. Well, we want to start with a look at the numbers that were reported yesterday by the USDA in those two important reports, the grain stocks and the acreage reports. The USDA reported, as shown on Figure 1, that June 1st, 2014 corn stocks were 3.854 billion bushels, and this is much larger stocks than we had seen the last couple of years, coming off the drought of 2012. That stock level is now approaching the level that was last seen in 2008, 2009, and 2010. Of course, what really matters to the marketplace is how that number compares to what was expected, and the market guesstimate, as it's called, going into the report was about 3.722 billion bushels. So the stocks came in well above what the market was expecting, which also, of course, implies that use was not as large as expected in the third quarter of the marketing year. Comparing those average trade guesses to the USDA reported numbers is shown in Figure 2, and we can see that there's quite a wide variation in the difference between the official USDA stocks estimate on June 1 and the average trade guess. In corn, there is a considerable amount of uncertainty and measurement error in the stocks because we don't get a full accounting of use in corn. So it's not particularly surprising that this number bounces around quite a bit from year to year. And you can see that we have had in the last 5 years or so some very large differences between the average trade guess and what the USDA reported. In a couple of cases, those differences exceeding 300 million bushels plus or minus. The most recent figure for yesterday's report, that difference was exactly 132 million bushels on the positive side, meaning that the USDA was above the trade guess by that much. So we can see it certainly wasn't the largest difference in recent years, but it is, in fact, on the larger side. What that implies is then when you take supply and then back out what we know for usage, is that implied third quarter feed and residual use of corn was 878 million bushels for the third quarter of the 2013-14 marketing year. That's right in the range of what we've had the last couple of years, but it certainly was substantially smaller than what the market had expected, which was just a little over 1 billion bushels, which would have been what you would have expected based on the USDA's annual estimate of feed and residual use and historical patterns. So apparent feed and residual use in the third quarter was on the smallish side. Moving on in the corn to the numbers out of the acreage report, the USDA reported a figure of 91.641 million acres of corn planted. That continues the downward trend of most recent years. And as the average guess figure of 91.725 shown on figure 4 indicates, that was very close to what the market was expecting, just slightly smaller, but not really a very large difference from expectations. That resulted, according to the USDA, in an estimate of harvested acreage of 83.839 million acres for the upcoming year. When we look at that difference between the planted and harvested acreage for 2014, that's coming in at just under 8 million acres, which we can see is obviously substantially less than those spikes we see in bad weather years like 2012 and 2002, a little bit larger than what we have historically seen, which likely reflects an adjustment for the larger base of planting that we're seeing in recent years. So just under 8 million for the difference between harvested and planted. Turning now to soybeans, we see that the USDA report on June 1st, 2014 indicated that the soybean stocks were 405 million bushels, which was indeed the smallest in recent years, even smaller than what we saw a year ago and substantially smaller than what we had been seeing since 2006, 2007. But despite that fact, that soybean stocks figure was substantially larger than what the market expected, or at least you could say moderately larger. The market average trade guess was 378 million bushels. So as we now look at the difference historically in recent years between the June 1 USDA soybean stocks estimate versus the average trade guess, that puts into historical perspective that while the differences in soybeans between the average trade guess and the June 1 stocks, the numbers are much smaller than what we saw for corn, which makes sense because we get basically an almost full accounting of the use in soybeans compared to corn from quarter to quarter. The difference, which was 27 million for yesterday's June 1 stocks estimate, was certainly large by historical standards for soybeans and certainly was a surprise given what appeared to be strong usage patterns in recent quarters for soybeans. So we can count that as a bearish surprise for soybeans. Turning now to soybean acreage, here was the real bombshell in the data that was released yesterday by the USDA. The USDA reported that planted acreage for soybeans in 2014 was 84.839 million acres. We knew that number was certainly going up compared to 2013. It was just a surprise by how much. The average trade guess was 82.154 million acres. So we have basically an extra 3.3 million acres of soybeans being planted compared to what we were expecting going into the report. That translates into a USDA estimate of 84.058 million acres harvested for soybeans. And that difference, for historical perspective, we can see that the soybean difference between planted and harvested varies much less in magnitude and volatility than corn, and that we're well within the historical range of what we have seen previously. So with that, that's a review of the basic data that was released for corn and soybeans in the reports yesterday. And now we'll turn to Darrel, and he's going to start taking a look at the implications for S&D in corn and soybeans. Take it away, Darrel.
Okay. Thank you very much, Scott. I think we want to work through kind of methodically here some of the implications of those reports for the balance sheet for the current marketing year for corn and soybeans, as well as the implications for the new crop balance sheet. I think it's already clear from the numbers that we've looked at and from the market reaction what the market thought of these reports, that they were generally bearish reports showing bigger stocks and more acres, particularly of soybeans, than expected. But the first question that we always want to try to answer from the June stocks report is whether the USDA's projection of feed and residual use of corn for the year is still a valid projection based on apparent use through the first 3 quarters. USDA has forecast that we will use 5.3 billion bushels of corn feed and residual for the marketing year. And what Figure 10 indicates is that to reach that level, fourth quarter use, June, July, and August, will need to total 563 million bushels. Historically, we have seen in the last several years some downtrend in the amount of corn used in the fourth quarter. There has been a systematic shift to more use in the first quarter and less in the fourth. So based on recent history, it seems that 563 million bushels might be a stretch for this year, although we may be feeding less wheat this summer because of price relationships. We would, at this juncture, probably have to discount the USDA's projection of 5.3 billion bushels. And that would be then shown in the what we would consider to be an updated balance sheet for the 2013-14 marketing year. And what we have shown here are changes on the consumption side compared to what USDA included in its June WASDE report. So where we would differ from USDA's numbers are indicated in red, and beginning with the feed and residual use, based on the June stocks number, we would discount that about 100 million bushels and bring that down to 5.2 billion bushels. USDA will update their own forecast on July 11th, so it'll be curious to see what kind of adjustment they make. Based on other information not included in these reports, we also would tweak projections for the other categories of consumption based on weekly and monthly estimates of ethanol production as well as exports. We are seeing ethanol production, I think, exceeding the rate needed to reach the USDA projection of 5.05 billion bushels for the year. So we've tweaked that up by 25 million bushels to 5.075. Conversely, the recent slowdown in weekly exports suggests that we might fall short of the USDA's projection of 1.9 billion bushels of exports. So we've moved that in the opposite direction by 25 million bushels. And now looking at total consumption for the year of just a bit over 13.5 billion bushels, ending stocks of 1.25 billion bushels. That would be 100 million bushels larger than the USDA projection in the June WASDE. That change is not enough that the average price for the year will differ not very much from the USDA's projection of 455. We are currently below that price level and will stay probably below that price level, but there's not enough time left or bushels left to sell probably to alter the average price very much. So this is kind of the negative component of the June stocks report, suggesting a slowdown in feed and residual use and prospects for a slightly larger year-ending stocks of corn. As we look to the new crop balance sheet, the first question that comes to mind is, can we anticipate any difference in acreage of corn relative to June intentions? Figure 12 kind of gives some history of that, and there have been a year or two since we entered into the freedom to farm era where actual planted acres has differed measurably from June intentions, most notably last year with the very late wet spring that we had. But for the most part, actual acreage has been within about 500,000 acres of June intentions. I don't think there's any indication this year that we should expect acreage to differ substantially from June intentions. One thing we will be watching are the upcoming reports from the Farm Service Agency where they will start estimating prevented planted acres based on farmer reports. But for the balance sheet for 2014, we will at this point just go ahead and use the USDA's projection of planted and harvested acreage. The bigger question, of course, is average yield of corn. Everybody starts by looking at the trend of corn yields over time and what the trend projection would be for 2014. And then based on planting conditions, early season weather conditions, crop condition ratings, make some judgment about whether we will be above or below trend. I think based on those factors right now, there's pretty general consensus that we're on track for doing an above trend yield this year. We calculate trend yield at somewhere 163 and a half bushels per acre. And I think we will probably be a couple bushels above that. I think the market is even trading a higher yield based on crop condition ratings. But in our balance sheet for 2014-15, you will see that we were sticking with the USDA's yield forecast of 165.3 bushels. Again, that's a couple bushels above trend, but we're not going all the way up to 168 or 170 at this juncture where we're hearing a lot of chatter. Our work would suggest that this extreme wet weather that we've seen in the northern Corn Belt probably is going to limit yield potential in those areas and may hold down the U.S. average yield to some extent. So obviously that's a tentative judgment on yield potential, but at this juncture it is big. That yield level would give us a crop just under 14 billion bushels, 13.85 billion, and a total supply of about 15 billion bushels of corn, considerably larger than last year's supply. Now the question is, what kind of consumption might we expect for the upcoming marketing year? And we start with the USDA's projections and then tweak those. And the differences that we have compared to USDA are shown in red on this chart. USDA and would look at feed and residual use at 5.25 billion. That seems to be a reasonable number at this point. With a big crop, there should be substantial residual consumption of corn. With high livestock prices, there should be some modest expansion of livestock numbers. The other area where we really differ from USDA at the margin is on potential ethanol consumption of corn and therefore total industrial use. we're plugging in a number of 5.1 billion bushels, 50 million bushels larger than USDA's projection. And that's based on a combination of a likely increase in the RFS for ethanol compared to the initial or preliminary rulemaking by EPA, but it also reflects, I think, a potential for a very robust export market for ethanol during the year ahead. So 5.1 billion. Exports, USDA projected at 1.7. We leave it there. The big issue, I think, will be China. Right now, it looks like China will have a very large corn crop, and the talk is that there may be minimal exports to China during the year ahead. And so that's why we see a modest reduction from exports of this year. Total consumption at 13.4, year-ending stocks projected at just under 1.7 billion bushels, which would be just under 13% stocks-to-use ratio. And then what kind of average price does that imply for corn? We were saying something in the low $4 range is probably what is implied by this balance sheet. And frankly, that's about where the market is right now. So potential for a big crop, a buildup of stocks, and lower prices of corn during the year ahead. As we finish here, we'll make a couple comments about perhaps marketing strategies on corn. But for now, let's move on to soybeans. While the June 1 stocks number was larger than anticipated, in our mind at this juncture, it didn't really generate any change in the balance sheet for this year. If there was going to be a change, it would have to be in the seed and feed category, the so-called residual use of soybeans. The stocks number implied a pretty low level of residual use during the first 3 quarters of the year, and particularly in the third quarter. So if we were going to tweak the balance sheet, it would be in that category, but we're going to wait till the September stocks report because there is some opportunity that stocks report will generate a change in the production estimate for the 2013 crop that might account for that larger than expected stocks number. So the average farm price for the year is going to be a bit over $13. We've dropped below that level and will continue to be below that level, I believe, through the summer months, but not enough to change the average for the year. The real issues are on the new crop balance sheet. And again, we start with asking the question, can we take the June planting number at face value, or should we find evidence that the actual acreage may differ? And unlike corn, we do find a lot of instances where actual planted acres differs by more than 1 million acres from June intentions. And I think that's because when the survey is done in many years, soybean planting is not complete. Still some issues about double cropping, prevent plant, that type of thing that results in larger differences. And given the way this spring unfolded, I would not be surprised if acreage either planted or harvested probably falls a bit short of the June intentions. So the magnitude of that, I think, again, will be reflected as we start seeing the FSA prevented planting reports. But if I were going to second guess the June number, I would probably tweak it down by 1/2 to 3/4 of 1 million acres. Maybe not enough really to change the balance sheet, but directionally I think we might find slightly fewer acres. Soybean yield, we also, like corn, we do see a trend increase over time. Early season crop condition ratings this year are near record good in terms of the percentage of the crop that's rated in that good to excellent category. We've had plenty of moisture. The real issue is whether we've had excessive moisture in some areas. But that leads to an expectation that we probably are on track for a record yield of soybeans this year. The previous record, 44 bushels in 2009. We're currently using a projection of 45 bushels for this year, and based on USDA's planted and harvested acreage estimates, that would give us a crop just under 3.8 billion bushels, which clearly would be a record yield and almost 500 million bushels larger than last year's crop. Give us a total supply of soybeans, 3.9 billion bushels. On the consumption side, we feel like the large crop, lower prices will give us probably some kind of response in terms of increased usage compared to this year. So we bump total consumption up to 3.54 billion bushels, again, a record by a fairly large amount, but still would leave us ending stocks about 380 million bushels and a stocks-to-use ratio of nearly 11%. That would be the largest stocks-to-use ratio that we've seen since 2006, and much larger than what we've seen the last couple of years. And the implication is that the average farm price for the upcoming marketing year will likely be much lower than what we've experienced the last 2 or 3 years. We've plugged in a projection of $10.25. As we look at where the current market is for both corn and soybeans, the corn market, as I mentioned, for new crop is pretty close to what we would expect to be the average for the year. The crop price has dropped below the spring crop insurance price, and suggests to us that perhaps there's not real urgency in pricing additional quantities of new crop corn at this point, given that the market has probably fully reflected prospects for a big crop and a buildup of stocks. Some difference in the soybeans. Soybean prices remain above our expected price by a fairly large margin, almost $1 higher than what we would expect the average to be, remaining just marginally above the spring insurance price, and suggest that there may still be some opportunity even now to price some additional quantities of new crop soybeans, even though we've had a pretty sharp price reaction to these reports. I think there is still some downside price risk on new crop soybeans. With those overview comments, we're going to conclude our presentation at this point. We'll now move on to the question and answer session, and we ask that you would continue to submit questions if you have those as we go through the question and answer period. We have received some questions, and we'll take a look at those and try to respond kind of in order as they have been submitted here. I think the first question was, does the feed and residual include ethanol? And the answer to that is no, that ethanol is a separate category in the balance sheet from feed and residual. Second question is, what is your estimate of the minimum, maximum, and likely summer feed consumption for corn? Going into the report, I had made a forecast that summer feeding would be somewhere around 450 million bushels. As indicated by the previous slide, we need to be well over 500 million to reach the USDA projection. So, somewhere between 400 and 475 is probably likely feed use for the summer. Even at the high end of that would leave us short of the 5.3 billion bushels.
Next question that came in is, What is the possibility that the USDA will find back even more old crop soybeans in the September 1 final stocks reports? And if so, how much? This is always a typical kinds of questions that you get. First off, I think for context, it's important to recognize that the adjustments that the USDA makes will be finalized with the next upcoming September 30th stocks report. It's not unusual for the USDA to basically reconcile the production estimates somewhat to the final stock estimates that we have in soybeans. And the reason they can do that is because we have pretty much a full accounting for consumption on the soybean side. And so they take the soybean stocks number as given, and then if they need to, they adjust up and down the soybean production estimate for the previous year. There's certainly discussion, given the third quarter usage, that well, why did we end up with higher stocks than the market was expecting if we're getting this full accounting? One implication may be that the last year's 2013 soybean crop was underestimated, and that the USDA will make some adjustment for that, depending on what the final Sep 1 stocks number turns out to be. What we know from looking at the data is that it is very hard to predict, based on one quarter's stock surprise, what that final adjustment might be. So at this point, I wouldn't say that we really know much of anything regarding the final adjustment that might be made. Very hard to predict.
So the question is, do you think U.S. exports for soybeans in the upcoming marketing year could be a bit overstated given the amount of South American supplies available to the market? That's always an interesting trade-off. And, in our balance sheet, we actually bumped up the export projection compared to USDA for next year, thinking that with the large supplies here, that we will be price competitive in the world market. We anticipate China will continue to be a large and growing importer of soybeans. So we do know that early season projections have quite a bit of noise in them sometimes. Actual exports deviate substantially some years. But at this juncture, I think circumstances would suggest we should have another very large and perhaps growing export market for U.S. soybeans.
Next question is, what's your favorite scenario for 2014-15 soybean use for biodiesel? That is definitely an interesting question, Darrel, given all of the controversies swirling around both the RFS rules for 2014 and the status of the blender's tax credit for biodiesel. So ultimately, the answer that you give to that question will be dependent on where you think those two policy debates are going to fall out. I'll give you my opinion. Darrel, he can certainly jump in here because this is certainly has a lot of elements of personal opinion. On the RFS side, I believe the best evidence that we have publicly available about where the 2014 rules are headed come from the RINs market. And in the last couple weeks, that market has been shouting that the rules are probably going to be revised even more than expected earlier regarding a rollback of the initially proposed cuts. So I think that that speaks to potentially larger biodiesel production in 14-15 because there's probably going to be some increase in the advanced mandate reflecting some increase in biodiesel. How much is difficult to guess. But more importantly, the real battle for the 2014 rules is what's going to be the ethanol mandate. And I think the signals are right now, I would say that that's a minimum of 13.8 billion gallons for 2014. And I wouldn't be surprised if it's larger. And so depending on what happens with the tax credit, that might just turn into extra gallons of biodiesel once you convert for the difference in equivalence there between biodiesel and ethanol. Another additional huge swing factor for projecting biodiesel in the upcoming year, what's going to happen to the biodiesel blender's credit? Now, interestingly enough, this is a place where I disagree with the RINs market. The RINs market has been behaving throughout 2014 as if that there's a very low probability that the blender's tax credit is going to be reinstated retroactively for 2014. I'm going to bet on history repeating itself, as we've already seen twice before at the last minute. It probably now would occur after the November elections, but I'm going to be very surprised if that blender's tax credit isn't ultimately reinstated retroactively, which would make biodiesel then the favored biofuel to fill in that gap between our ability to physically absorb ethanol and the ethanol mandate. So all in all, I think that there's definitely room for the biodiesel consumption in the USDA soybean balance sheet to move up from where it is right now.
Okay, someone's asking, what do you see that would trigger a price recovery? What would be the timing of that, and what would be the event that would do that? I guess the obvious answer at this time would be some kind of a problem with the developing crop here. Other than that, I think you would have to look longer term at potential problems with production outside of the United States. And barring that, you would have to look for some kind of a substantial increase in consumption compared to expectations at this point. With production prospects really being quite large, to trigger any kind of substantial price recovery, I think would take a substantial change in weather or demand that we really don't see at this point. So I think what we're hopeful for or expecting is that we will see maybe prices of corn stabilize at current levels. And soybeans, I think it's going to be very, very difficult to generate any kind of near-term price recovery. Scott may have additional thoughts on that as well.
Yeah, I agree with Darrel that it's very difficult to see a scenario where you would see some kind of robust recovery in corn and soybean prices. Probably the potentially one bright spot is on the corn balance sheet, where there could be some modest surprises coming from ethanol usage. There's a lot of volatility in whatever the final outcome might be with regard to the EPA and Obama administration's policies regarding implementation of the rules for 2014. And even if they stick with their initial proposal, that's likely to be challenged in court. And from what I have seen, and consulting with legal experts, it's certainly a 50-50 kind of deal whether those rules would survive a court challenge. So the game is not over in terms of some positive surprises on ethanol usage going forward. And we've continued to have a robust export market. And particularly with these price levels of corn that we're talking about, U.S. ethanol will continue to be the cheapest source of octane for mixing in gasoline blends through most of the world. And I see a scenario developing where it's possible in 2014-15 that the issue on the ethanol side is that our use basically is going to be capped by U.S. production capacity for ethanol. Again, that you have to keep that in context. The most wildly optimistic scenario would be corn ethanol usage of perhaps 5.5 billion bushels compared to, I believe we projected 5.1 in our balance sheet today. And, given the size of stocks we're estimating, that would certainly have some price impact, but it wouldn't return us to really robust levels of corn. But that's the one area where I think bears watching as we proceed.
The question is, do you think farmers continue to hold large quantities of unpriced corn that will weigh on the market as they sell it to make room for the large crop on the horizon? It's a little hard to tell how much corn farmers actually own. USDA tells us how much corn is on the farm and how much is off farm. But we don't really know who owns that corn. We assume that if it's still on the farm, that the farmers own most of that. But a substantial portion that's in the commercial facilities may be owned by farmers as well. Given the fact that total corn stocks are larger than a year ago, I think it's pretty safe to assume that farmers own more corn on June 1 this year than they did last year, and that the majority of that will have to move to market before the new harvest. So the best scenario would be that would be an orderly marketing pattern. I'm guessing at this juncture that with the sharp price decline that many farmers will take the attitude, let's wait one more month and see if any crop problems do develop that would give us a bit of a bounce in the market before we sell. So if that does happen, we could see some bunching of those marketings come in late July and August. That would certainly add to a bearish scenario presented by a very large crop. So, just the fact that we've got big inventories out there that regardless of who owns that is going to continue to weigh on the corn price.
One question that's come in, interesting to discuss, is what does this outlook mean for land prices? On one hand, if you just simply focused only on the market returns to corn and soybean production, clearly income is going to be reduced. Our colleague Gary Schnicke recently projected that in Illinois, income to grain farms is going to fall back down to basically the level of income per farm that was existing previous to the boom that started in 2006. So that could make one kind of pessimistic about land values. But it's very important to remember two things. One, there is for the current year, a fair amount of support in terms of safety net that we get from revenue insurance. But even more importantly, the farm bill that was passed recently basically sets a floor for income that is near the level of prices that we're currently projecting in our balance sheets. So we don't see the prospect for income for corn and soybean acres to fall net of government payments and crop insurance substantially below the levels currently being projected. So we think that provides a real safety net for farmland prices. It certainly might put, and that's what we've seen in the last year, it's put a damper on any enthusiasm for projecting higher rents and higher land prices going forward. Probably the more significant risk on land prices is a jump in interest rates, which might follow a change in Fed policy to substantially reduce their quantitative easing monetary policy. I think that's probably going to have a bigger impact on land prices than our current grain price outlook. I don't know, Darrel, you might want to add to that.
That's sufficient.
Okay.
Let me just select some questions here. Considering third quarter feed consumption of corn was lower than last year, then our thoughts that summer feeding would be higher seems optimistic. So how would you reconcile a year-over-year decline in the third quarter but a year-over-year increase in the fourth quarter? I think that points out kind of the shortcomings of just doing a year-over-year comparison rather than thinking in absolute terms, because clearly summer feed and residual use of corn last year was extremely small, almost unbelievably small. And it just comes back to this whole issue of that what we're looking at is feed and residual use of corn, not just feed use. And the fact that corn is much more competitively priced, I think suggests that summer disappearance will be more consistent with years prior to last year, which was historically low and kind of an unbelievably small number. So we'll see when the September stocks number comes out, but right now you would have to say we would be on track for a more normal level of summer feeding.
One question that's coming in, will we stabilize at these levels? I wanted to add some comments there in terms of, both a short run and a longer run perspective. The short run is, the answer is probably not if corn yield prospects continue to improve. We'll just see ending stocks estimates continue to grow, and probably kind of that long, slow grind down to seeking a new equilibrium level here in the short run. We think that the market right now is probably trading something like a 168 bushel yield for corn, which is just a little more optimistic than we are at the present time. But we certainly recognize that that is a real possibility of corn yield that high. What I think is probably even more appropriate is, what does this mean? This kind of a circumstance where we now see new crop corn bids having a 3 at the beginning in many areas prompts a lot of fear of, is this the end of the long boom in grain prices that began in 2006? Will we return to having to struggle with, corn prices in the $2 range and those kind of things? We continue to firmly believe that is not going to be the long-run scenario. That Darrel and I have published a number of times our long-run projections for average corn, soybeans, and wheat prices. We don't see anything that would suggest that in the long run, a corn price of around $4.50 a bushel, why that won't be the new equilibrium. That does not mean that we can't go for a number of years at prices below that, and below that by a considerable amount. But we still think that the supply and demand fundamentals support that as a long-run equilibrium price on corn.
Somebody picked up on the observation that China is currently expected to have a pretty decent corn crop. What are your thoughts regarding China's ability to meet more of their soybean needs in the future and importing less soybeans? That probably is not going to happen. I think Chinese soybean production has been stagnant for a number of years, and I think they recognize their limited ability to expand soybean production, are focusing more on feed grains, obviously corn, and I think are content at this point to continue to import large quantities of soybeans. So I don't look for, other than just annual variation based on weather conditions, I don't really look for a trend increase in soybean production in China. A related question is China's purchases of new crop soybeans are running well below last year at this time. Do you expect USDA to reduce their China demand for soybean in the forecast for next year? I kind of alluded to that earlier, that we continue to maintain a big forecast. I think I would have to review the facts, but I believe that China has been a very aggressive early season buyer of soybeans the past 2 years, have bought much of their needs even before harvest. What we may be seeing this year is a return to a more normal buying pattern where they also see big crops coming in the U.S. and no urgency perhaps to be aggressive buyers this early. So I would be surprised if USDA changes their forecast in the July WASDE report just based on the purchase pattern so far this year.
A related question on China is if China again starts to import U.S. corn, how could this affect the U.S. corn markets? And has the rejection of MIR 162 and Duracade corn been an added bearish pressure on the U.S. corn market? I don't know that we've seen a great deal of pressure, downward pressure, because of those rejections of those biotech traits on corn. Where you really have seen that pressure show up is in the price of DDGs. When that started to happen, the price of DDGs really collapsed relative to corn, and I think that's where you've seen the big impact.
One question I've been avoiding here is what is the projected supply situation for other feed grains other than corn, given drought conditions in some areas? The most important other feed grain, of course, is sorghum. What we did see in yesterday's acreage report is that planted acreage of sorghum exceeded March intentions, but is smaller than last year's seeding. The majority of that sorghum acreage is in Kansas and Texas. And in spite of some early season drought, weather conditions have really improved in those areas. And that's reflected really if you look at the corn crop condition ratings. Those have been increasing substantially for both states in the past 2 or 3 weeks. So the big issue on sorghum, I think, will be Chinese demand. That's been the story this year, is that China has backed off of U.S. corn to some extent, reportedly because of biotech traits, but have substituted sorghum there. If they do have a large corn crop this year, then their demand for sorghum would probably wane as well. So I don't think we can see any price support perhaps for corn coming from the markets for other feed grains at this point.
One question that was submitted is how how might this outlook impact 2015 and future input costs? Again, I'd refer to Gary Schnitke's work. He is included in his projections for 2015 reductions in seed and fertilizer costs with the lower grain prices, but those certainly have not been large enough to even come close to offsetting the revenue declines, particularly for corn. So the longer-term outlook with this kind of outlook at the present time, unless something changes, for much more moderate corn and soybean prices, I think you will continue to see some downward pressure on seed and fertilizer input costs. Of course, that leaves the big enchilada, Darrel, out there, and those negotiations are really ongoing and will be coming to a head in the next few months. One question that submitted was, how do you suggest operators address lower revenue with regard to cash rent negotiations? I'll read the question, Darrel. Do you have any advice? I think probably one of the things that I can reflect on this, having some experience in these areas personally, I think it's helpful to just get the facts on the table to start with. And that's where, again, I think the work here in Illinois, at least, that Gary Schnitke has done, can help establish an objective, unbiased, third-party analysis of where we stand in terms of expected income generating potential from corn and soybean production in Illinois. There's lots of good work from our colleagues in other surrounding states here in the Midwest, for example, at Iowa State and Purdue, for Indiana, and use those as at least establishing kind of the general environment we're in, which is sharp declines in projected revenues going forward. That's kind of the main point that I see. It's a hard fact, and that certainly can create lots of tension and anxiety in those negotiations. But the facts are what they are, and we are basically a combination of increases in input prices and cash rents over time, and now lower commodity prices have basically squeezed us back to the point where we're about the same income levels for land as we saw previous to 2006, 2007. I don't know if you have anything you want to add on that, Darrel. No, bail me out of any big holes I've dug for myself.
No, I mean, I think to a large extent, the issue is pretty obvious to everybody. There's less money to share, and the question is how do you work out the arrangements to share less revenue, and recognizing that there's still a very competitive market for land out there, and so it's a real balancing act.
That's right, and there's no easy answers other than I would at the same time our research shows that cash rents in particular are highly likely to be sticky, adjusting downward because of the competition that we have for land. In particular, you add to that equation the kind of machinery investments that have been made here in the U.S. In recent years, lots of incentives to try to spread those fixed costs once they're purchased over as many acres as possible. I just think we'll probably see a real stickiness, and it'll take some time for those cash rents to ratchet down much is what I expect. Time for a couple more questions. One really optimistic question submitted: how low can the average corn price go with higher than expected yield? Interesting question. We put in 415 for our 14-14 14-15 corn price projection, which we expect will probably be a little higher than what the USDA comes out with when they update their July WASDE balance sheets, because we're a little less optimistic than I think is the consensus on yields, and a little more optimistic on some of the use categories. So that accounts for that. I'll put it this way. What if we get a 170 U.S. average corn yield, which we certainly would not dismiss as a realistic scenario? Clearly, that would push, I believe, our forecast, Darrel, below $4, and I would probably be in the 385 range in that kind of scenario. What do you think, Darrel?
Yeah, I think some indication is given in the USDA's June WASDE report when they forecast the possible price range for the 14-15 marketing year. The low end of their range was a 385 average price.
That's right.
And certainly with a yield that approached 170 bushels, we would push the average down towards that level. And also recognize that some of the work that Scott alluded to earlier that we'd done on potential price ranges during this new era of prices, we did acknowledge that prices could average as low as $3.50 at points if you have big crops and a substantial buildup in stock. So, the mid to upper $3 range is certainly possible if the crop reaches its full potential this year.
So, on that happy note, we're going to now conclude our webinar today. We thank you for your attendance and tuning in. We do want to just make sure that you do know that our slides are available now at our website. And check our website for recorded version of this event if you want to go back and listen to any of the Q&A answers or parts of our presentation. That'll be available no later than tomorrow and potentially even earlier. We appreciate, again, your participation, and please join us again and visit the FarmDoc Daily and FarmDoc websites for an updated events schedule going forward in 2014. Have a great day.